Hey guys, I'm Angelo, and welcome back to Crypto Coin Consultants. Technical analysis is one of the most powerful methods of predicting market price and direction in the world of cryptocurrency. This will be the first video in a multi-part series where I'll teach you the basics of technical analysis. There are other alternatives and methods you can use, but my goal with these videos is to provide just enough information for you to get started to successfully trade. With every tool, indicator, or pattern I show you, I'll first introduce the concept, followed by a live on-screen demonstration on how to actually apply the concept. Let's get started. Before we continue, don't forget to subscribe to the channel and hit the like button to stay tuned for more crypto-related info. The first and most common thing you'll see when opening up a graph are green and red bars, called Japanese candlesticks. These candlesticks indicate the direction the price moved within a given time period. So if we want to look at the one-day charts, each candlestick represents the price movement for one entire day. If we look at the body of a green candlestick and ignore the lines extending above and below it, we'll see that the bottom line indicates the price that coin opened for that day, while the top line tells us the price the coin closed at that same day. The lines extending outwards are called wicks and indicate both the lowest and highest prices the coin sold for within that one-day period. The only difference between a green candlestick and a red candlestick is that a red candlestick indicates that the coin's price closed below its opening price, meaning price moved downwards for that day. Let's put this into action. Looking at Bitcoin's one-day graph, which you can see I've selected here by clicking on one day, you'll see the prices for the open, high, low, and close represented by O, H, L, and C respectively. Hovering over to January 5th, 2018, we can see that Bitcoin opened at $15,143 for the day, at some point dropped down to $14,810 and reached as high as $17,200 during that same day, and finally closed at $16,928. 3 days later, on January 8th, 2018, Bitcoin opened at $16,173, reached as high as $16,300, dropped all the way down to $13,900, and finally closed at just under $15,000. The next thing I'd like to discuss is what you'll hear referred to as support and resistance. These are price levels in which the price of a coin is prevented from being pushed further upwards or downwards. Support, also referred to as a floor, is a point at which a coin has repeatedly dropped to a certain price point before being bought up again. Resistance, also known as a ceiling, is the opposite, the point at which a coin has repeatedly gone up and touched before being pushed down again. Keep in mind that support and resistance levels are merely zones, meaning they act as a general area in which price is predicted to bounce off, rather than an exact price. You can use support and resistance levels to your advantage by buying low when a price reaches an expected support level, then selling it off when it hits its resistance. One thing to note too is that when price breaks a certain support level, you'll oftentimes see that same former support level act as resistance later on down the road, and vice versa. Now let's get back to the charts so you can see exactly what I'm talking about. Looking at Ether's 6-hour chart from mid to late December of 2017, we'll see that the price of Ether was repeatedly facing resistance around $750. With the exception of December 18th, 2017, every time it hit resistance, price went back down until finally, on January 1st, 2018, it broke through. You can also see that that same $750 ceiling later on acted as an important level of support here, here, and here, in which price moved back up after touching it. The last concept I'd like to cover in this video is a tool called a trendline. As its name implies, trendlines show the general trend of a particular coin's price. A coin's price trend can move in one of three different directions: up, down, or sideways. You can think of trend lines as sort of dynamic areas of support and resistance, which will make more sense once we look at the charts. Again, these are general areas or zones of support and resistance, and are difficult to pin to an exact price. Some key things to note are that 2 touches to a trend line form a speculative or tentative trend line, while 3 touches to a trend line are a confirmed trend line. A touch is made distinct from another touch when they're separated and spaced out from one another, rather than clustered together over the course of a smaller time frame. Thus, bigger time frames like the 12-hour or 1 day, for example, lead to more valid trend lines. The more times price touches a trend line, the stronger or more powerful it's considered to be. Longer trend lines are more powerful, meaning the longer the trend line has been intact, the more likely you are to see this line get respected, and for price to predictably bounce off it. But keep in mind that the more powerful the trend line is, the more violent you'll see price react once it does manage to break that trend line. Going back to Bitcoin's 1-day chart from May through December of 2017, for example, we can draw a confirmed trend line here. Note that price touched and at times came close to touching the trend line more than 3 times. Late October, early November saw price test it and break through, but it was suddenly pulled back down until it broke through again in mid-November and reacted violently with an almost 200% increase in price over the course of about a month. Alright guys, that wraps up episode 1 of my new multi-part technical analysis series. Stay tuned for the next video where I'll be showing you even more TA tools you can add to your arsenal. Thanks for watching, and feel free to ask questions or make any requests in the comment section below. And before you go, don't forget to subscribe, hit the bell button to get notified of new video releases, and give this video a nice thumbs up. The platform operates on a trustless concept, as the arrival of particular shipments can be verified through digital escrows that have the encrypted waypoint information and data about the loads. Conflicting stories about the whereabouts of certain goods are thus taken out of the equation.